Hi, welcome to week 4, halfway through the semester already. Last week we covered forecasting, cash forecasting, sort of that first time when we went from looking in the rearview mirror to taking that information, coming up with a thoughtful projection about where we're going to be going forward. Really zoomed in on cash specifically, how much cash we would have in on a 6 month basis, so month to month to month. Um, Remember that part, because going forward, as we keep talking about valuation and as you perform valuations on your individual companies you've selected, you're essentially going to be doing the same thing, only on a yearly basis. You're going to go out 5 years. There's a model that you can use for that. And so you'll be going forward for your final project, you'll be, again, forecasting going forward what your final ultimate called free cash flows will be. We'll define that later. And then you're going to be discounting it back. When we introduce future value and present value, we'll be seeing how that works. But again, the foundation will be you're going to create a forecast year by year for 5 years out. You're going to say, okay, what are my free cash flows essentially going to be at the bottom? Here's my sales. Here's my operating costs, right? Here's what I got to spend to fix up my business, called CapEx. And then here's my free cash flows. So you'll be doing that for 5 years. So again, remember that when we get to that point, that's how this forecasting module that you just did fits in. So week 4, we introduced something called operating financial leverage. So what that means, it means two things. So when we talk about operating leverage, what we want to understand is, as a business, we're going to be producing stuff. We're going to be producing some things, not necessarily a service. So what we want to know is, we as a business, we want to know how many units do we need to produce of the thing before we're completely at zero for our operating costs. We're at zero, right? So maybe it means that in the course of a year, if I produce X amount of units, maybe around March, I'm at break even, and everything from April on is all going to be flow to the bottom line, just as an example. More importantly, though, if it's on a monthly basis or a quarterly basis, maybe it's on a job basis. Maybe it's Apple producing millions of their phones. And this is not a great example because their margins are so big, but nonetheless, Apple margins are about 50%. So you need to produce X amount of Apple margins before you can pay off your fixed costs, right? So you have a margin, your gross margin, let's say, right? I sell the unit for 1,000 to people. It costs me 500 to make, so that means I have a gross margin of 500 per unit, 500 per unit. So how many of those units do I need to sell before I pay off the fixed cost for Apple, right? The fixed cost to make those phones. And fixed cost could mean in the factory, right? Stuff like that. I guess you could maybe you could even call some marketing fixed cost. But generally, it's your infrastructure that's tied into it that doesn't change no matter how many units you produce. So that's a great way to run your business, because then you can have a sense of, I can make this much more profit that will flow to the bottom line if I produce this many units. And also, maybe it's finite. Maybe I barely need to produce X amount of units to be in the black or the red. So it's simple enough module. You'll see the sort of the letters with fixed costs and marginal costs. But in a nutshell, it's how I explained it. What your gross margin is going to be, and then how you're going to amortize your fixed costs. That's the word I'll use, amortize. So The book also talks about something called financial leverage. So when we're buying, when we're building those fixed costs, when we are, let's say we're Intel and we're making computer chips, it's estimated that a plant can cost $1 billion for a plant for a new chip. $1 billion after all is said and done and all the quality control is done. So essentially, I need to borrow. I probably got to borrow money, raise capital to get the $1 billion, right? So now, if we implement that whole same break-even analysis to that, I'm adding another dimension and another level of thoughtfulness of, okay, if I'm gonna create a new chip, which companies are trying to do all the time, they're smaller and faster, etc. I need $1 billion of fixed cost for my plant. How am I gonna build that? Okay, I'll borrow money or I'll raise capital somehow. So leverage refers to borrowing the money. Okay, that's a key word. Leverage. When you hear that word leverage, we're borrowing the money. So if we're borrowing the money, more will fall down to the bottom line to stockholders. Okay, when we raise capital, we can either borrow the money or we can sell stock. So there's shareholders and there's lenders. If we raise the money from lenders, that means all of the proceeds of that investment will go to the shareholders. Okay, so you're going to get this sort of stakeholder conflict where when you are going to raise that $1 billion for the plant, each party is going to say, sell more. The bond people are going to say, sell more shares, don't borrow more money. I already lent you money. I don't want to worry about that. And the shareholders are going to say, I don't want to issue any more shares because something called dilution will happen. Dilution means there'll be more shares, and I got to share earnings with everybody else. So you're going to constantly have both. So there is a happy medium. There is a happy medium of leverage where you may borrow enough and you stay safe. So if you'll remember 2 weeks ago with financial ratio analysis, some of the ratio analysis you looked at was to see how safe the business was for lenders. Lenders are worried that you're not going to have enough money to pay off the interest, right? As you borrow more money, you have to pay the interest back, right? So one thing called times interest earned, EBIT over interest, that showed us how many times you could pay the interest off. Lenders are very interested in that metric, right? And so shareholders again are going to be saying, yeah, just borrow the money. They don't care. At some point they will care, because if you get too leveraged, then you're a risky company. So that's where the two combine in this this module. Okay, a topic to think about is if there's a mantra, a takeaway that says other people's money. That means I'm a shareholder. Let's raise the money from someone else, right? To add to our business, to add to my bottom line. Okay, then why not just fully borrow everything for the company? Maybe don't even have any shareholders, right? But just borrow. Think about that concept as we go through this module. Like, think about why not just borrow, fund every bit of your business with debt. Okay, again, debt equals leverage. Okay, so good luck this week, and again, hit me up with any questions.